America, there is an inheritance tax. If, let's say, one has $100 million worth of wealth, and when he dies, he can only transfer probably 45% to his children. 55% is grabbed by government. That's an interesting law.
This is what Indian Overseas Congress Chairman Sam Pitroda said on 24th of April and fueled the ongoing wealth redistribution controversy. Basically, he advocated a US-like inheritance tax law in India, which drew criticism from the BJP, so much so that the Congress distanced itself from his statement. But what is inheritance tax law? And was there such a mandate in India too? Well, let's decode this for you. The United States levies two types of taxes, estate tax and inheritance tax. Around 12 states impose estate taxes, while 6 states enforce inheritance taxes. Inheritance tax is applicable when the person who dies passes the assets to his kin or any other beneficiary. It is the state where the descent lives and not the beneficiary that determines if an inheritance tax applies. The tax rates ranges from less than 1% to 18% of the value of property and cash a person inherits, but they can change each year. Now, how does this taxation work? An inheritance tax is applied only to the portion of an inheritance that exceeds an exemption amount. The exemption amount is usually quite high, at least $1 million. The rates above these thresholds are determined on a sliding basis, ranging from 1% to 18%. Those who are closely related to the deceased usually get higher exemption and therefore pay lower taxes. The tax is calculated separately for each beneficiary and they are responsible for paying the tax imposed on it. Now, what other countries have this provision? You might be surprised to know that inheritance tax is quite common worldwide. As many as 20 OECD countries impose recipient-based inheritance taxes. The inheritance tax rate globally ranges from 10% to 55%, depending on the value of the inherited item. Japan has the highest inheritance tax rate in the world at 55%, followed by South Korea at 50% and France at 45%. Now, was there an inheritance tax law in India? Well, interestingly, there was a similar taxation system in India 40 years ago, and former Prime Minister Rajiv Gandhi had scrapped it. The Estate Duty Act was introduced in India in 1953 to address economic inequality by introducing an estate duty tax. This tax was designed to be progressive, with rates increasing up to 85% for estates valued over Rs 20 lakh. It applied to both immovable and movable properties. One had to pay the tax for transferring assets from a deceased person to their kins. The tax was based on the total value of the estate left behind by the deceased person, and the kins were required to pay a certain percentage of this value as tax to the government. The tax was abolished in 1985 due to complexity of the law that resulted in litigation and administrative costs. There were concerns about double taxation as well, as assets were subject to both estate duty and wealth tax. Hope you found this video informative, and for more such content, keep watching Money Control.